Hey guys, Eric here, Mr. Fired Up Wealth, and I'm excited about today's video. I'm doing something a little different here. If you remember back, well, you probably don't remember this, but Franklin D. Roosevelt, FDR, President of the United States, back in 1933 to 1944, addressed the nation with a series of radio chats to the American public, and he called it FIREDside chats. So I'm starting kind of a new series. It's not really a series. It's just going to be something I do periodically called FIREDside chat. This is episode 1. And what we're going to do today is I set up a poll in our Facebook group. Now, if you're not in our Facebook group, you should go apply. Go onto Facebook, type in Fired Up Wealth. If you're not in the group, it's okay because everything that we cover in this video is going to be relevant to you if you're a stock market investor. So I created a poll a couple days ago. Basically asked the group what I should make a video on. And I got a lot of different answers. I'm actually looking at my screen here, and I'm going to read you the different questions and also the different poll topics that people voted on. And I'm going to address all those in this video. So let's just get right into it. The very first one, we had 59 votes, was how and when do you shave profits and or rebalance your portfolio? I get this question all the time. It's a really hard question to answer because it depends on the person. It really depends on what your goal is, not only overall your strategy, but why you bought the stock in the first place. In other words, when I buy a stock, I generally have a horizon or even a price in mind when I buy it. So when I buy something like Fastly at $20, my target actually was $50 in 2 to 3 years, and today it's trading at $86. Okay, well, should I just sell it then and move on? Well, probably should take some profits, maybe shave a little bit off, and then let the rest run is what you should probably do. I have not done that yet, but I'm definitely considering it. And so to answer the question as best I can, how and when to shave profits and rebalance your portfolio. So if you watch the other videos, I always want at least 5% cash. Sometimes you have to shave some profits to get to that cash. Sometimes you shave profits because something is just frothy. Like, for example, say you bought Fastly and it went up, 700%, 800% in a couple of weeks or a month or whatever it's been. You might just sell all of it. You might sell half of it. That's totally your call. You have to look at it and say, do I think this stock is going to keep going higher, or is it just overdone? I've already made my money on it and I'm going to move on. That's a personal decision on every single stock that you buy. The other thing is, do you have a long-term or a short-term horizon? So are you trying to retire in 10 years, or are you trying to retire in 10 months? If you're retiring in 10 months, then you should probably sell a lot of stuff and move to cash. So that's the best I can do on that question, guys. It's a hard one to answer. The second one is from Russ, and I won't say any last names just to respect privacy and everything, but he asked for a review of ARK, SKYY, WCLD, and other ARK ETFs from the past videos. Are they still a buy? Well, obviously it would have been a lot better to buy them when they were lower. So would I buy them right here? That's tough to say. It depends. If I'm dollar cost averaging as a core, then yeah, you could add a little bit. I wouldn't be going all in on any of these, on really anything. I haven't bought any stocks, guys, for a couple of weeks. I've been shaving positions. So just be careful with what you're buying here. Don't chase it. No FOMO. So is it a buy? Do I think that those ETFs are going to be worth more in 5 years? I do. What's going to happen between now and 12 months? I don't know. Can they lose 10% of their value, 20% of their value, more? Yeah. Do I think that WCLD is going to be worth, more than what it is today in, say, 5 years? I do. I believe in that ETF. I believe in the companies. I believe in, the secular growth trend of that ETF. So is it a buy? Yes. If you're taking all your money and you're going to buy it right now, just expect some pain. You might lose a lot of value before it goes up. ETFs, guys, are best used in retirement accounts because in retirement accounts, you cannot tax loss harvest. So they work very well in retirement accounts. You can also use them in taxable accounts. If you're going to use it in a taxable account, it works really, really well to use it as a core that you consistently add to in dollar cost average every time you get paid, every 2 weeks, every month, whatever that is. That's what I would do with ETFs if you're doing it in a taxable. I'm constantly trying to add money into those. I also will take profits from other growth stocks, and I'll buy either DGI, Sometimes I just put it into simple ETFs. So keep that in mind. What are some good speculative stocks for the next years? Well, I'm trying to make a couple other videos. I need to find time. One that I've liked, that I've told you about a couple of times, it's very high risk, high reward. It's a penny stock. The ticker is VBIV. It's a vaccination play. Take a look at the website. I think that there's a lot of room. I was buying it at 90 cents. It's worth $2.75 or something a day. It's very volatile. It can go up 20% a day. It can lose 20% a day. I think that's probably going to be a $4 or $5 stock in the next 12 to 18 months. But it could also, it could get devastated too. It's a penny stock. So high risk, high reward, but that's one for you to take a look at. Different strategies of withdrawing funds while living under FIRE. This is something that's not talked about enough. So if you're into FIRE, that's financial independence, retire early. I'm about financial independence, retire early with dividends. And my approach, what I do is I try to gain enough capital so that I can live on the dividends and never sell the assets. So the idea behind that is that, say you have $1 million, $2 million, whatever that number is, you adjust your yield accordingly to fit your lifestyle, and you're basically never selling that stock. So I'm not doing the 4% rule. Can you do the 4% rule? Yes, there are lots of ways you can do it. You can do the 4% rule. The other way you can do it is if you have a retirement or a pension, say at age 60, and you're going to early retire at 45, you need to calculate how much income you need yearly for that 15 years until your other money kicks in. For me, I've got a built-in hedge because I'm going to be able to retire at, say, 45, be able to live off those dividends all the way until retirement. And then at retirement, I'm going to have more income coming in. And in theory, those dividends are going to continue to pay more each year because of dividend growth investing. And that should outpace inflation. Plus at age 60, I'll get my regular retirement from IRAs and things like that. And then Social Security will kick in at, whatever age you decide to take Social Security. There's different rules on that. But in theory, I'm going to continually make more money as I age. So I should always be able to outpace inflation with that approach. You need, quite a bit of capital to make that work. If you need, $50,000 a year to live on in retirement, so you have no debt, well, $1 million, that means you need 5% yield. There's different ways to play that. A breakdown of your drawdown strategy, we kind of just covered that, in a TikTok dance challenge of your choosing. So Mike, unfortunately, I'm not going to do any TikTok dancing today. Not really my thing. So we'll just move on to the next one. Strategies for your portfolio as COVID-19 numbers spike and the CARES Act stimulus payouts for unemployment end on July 31st, 2020. So what I've been doing is I have been shaving some profits, getting my cash position back up in between that 5 and 10% mark. I'm never going to liquidate my portfolio and try to time the market. That's not my strategy. My approach is long-term, buy and hold, and then be strategic around it. So I'm actively managing it, but I'm not going to liquidate half my portfolio and hope for a 30% drop. I'm not doing that. I'm always trying to keep a 5 to 10% cash, disciplined approach, and have money for those dips to buy opportunity and even add to positions that I currently have. Approach criteria on buying high and selling higher. Well, I prefer to buy low and sell high. So, I get where you're going with that. You're trying to basically say everything's overpriced, so what are you buying right now? Well, I'm not really buying a whole lot right now, guys. So that's a tough one to answer. I look at secular growth trends. I look at things, if it's a SaaS play, I look at like a rule of 40, I look at a grit score. I try to look at the SWOT analysis, what the strengths are, the weaknesses, the opportunities, the threats for each company. It's really such a personal thing, investing. Every stock is different, every situation is different, every person based on their suitability and risk is different. So some of these questions are very, very hard to answer. I'm just doing my best to kind of give you my thoughts just off the top of my head without any script or anything like that. So Russ is saying here, idea was for long-term, not short, didn't clarify. I get that it's for long-term. I kind of addressed that in the first part though. Some of those ETFs, they could certainly go a lot lower before they go higher, but long-term, I still like them and I still own them. A lot of tech stocks in some industries like Home Depot, Costco, Walmart, and Domino's have bounced back from COVID lows back in March. But the last 90 days was a great buying opportunity for discount quality stocks What should you do with your portfolio when some stocks are not bouncing back and are still negative 30% from COVID news, like IOSP? Or what if you still have Boeing, Apple, Nvidia, Netflix? So FANG are at all-time highs. When is a good time to cut your losses? How do you justify jumping on overpriced, super high-priced stocks? So that we just kind of covered the best I could. I still believe in Amazon. I still believe in Apple. I still believe in Microsoft. I don't own Facebook or Netflix currently, other than in ETFs like QQQ. But you know, those are ingrained into our society. I mean, Amazon's they've only benefited from this whole COVID thing. Apple is growing their services businesses. We have a huge 5G wave in front of us. Is it high price right now for some of these? Yeah, it is. But you know, I've had Amazon since $500, and everybody says it's too expensive, and it keeps going up. So, do you just sit on the sidelines and wait, or you know, do you only invest in things that you know, only invest in things that you're comfortable with. And if you're not, don't invest. If you're not comfortable and you own it and you're up, sell it. And then you don't have to worry about it anymore. I can't make that decision for you. You have to decide whether you believe in a company and their management and you know all the different risks and opportunities ahead of it, and if it's going to be a good play. Look at Nvidia. Is Nvidia going to double, or you know, is it going to lose half of its value? I mean, you can have an argument just in that one stock for an hour with one of your friends. I think Nvidia has a lot of opportunity because of, you know, autonomous driving and data centers and all these different things. And I understand SaaS software because I work in the industry. I understand the benefits. I understand the movement. I'll give you just one quick example. When you look at something like Oracle. So if you're on 9.1 PeopleSoft, this is old legacy on-prem, they are not going to service that in a year. So in 1 year, end of next December, of 2021, if you've got PeopleSoft 9.1 and you have not upgraded, there's no support from Oracle. If something breaks, they say sorry, even though you've already paid millions of dollars for the software and to implement and all that, it's not going to be supported. So your option is to switch to SaaS, software as a service, or you can do a lift and shift or move and prove into a cloud environment. They call it OCI in that situation, Oracle Cloud Infrastructure. Obviously, you know, OCI competes with Amazon Web Services, with Google Cloud, even with Azure. So you literally can take those on-prem applications and you can lift and shift, move and improve into a public cloud like the ones I just mentioned. That creates a lot of opportunity. Once those companies that are now in the cloud, and out of just Oracle, and you look at their legacy on-prem, 68% of their customers have not gone into the cloud in any capacity. So that's how much room's left just in that one enterprise software solution. And they have something like 15,000 e-business suite customers, 5,000 PeopleSoft customers, you know, 5,000 JD Edwards customers, all these customers, and you got 68% that have not gone to the cloud. Once they do an OCI or a SaaS type move, now they have the ability to integrate with all these other SaaS plays. So even like an OCI type of environment, Oracle Cloud Infrastructure, that's IaaS and PaaS infrastructure and platform as a service. When they get to that point, now they can integrate with things, you know, like Datadog very, very seamlessly with APIs, with CrowdStrike, with all those different things. So, you know, it's a secular growth trend. You have to understand it or you don't. If you think it's too high, don't buy it. I mean, I don't want people buying stuff they don't believe in. And know that when you are buying those type of stocks, that there's some risk, and not every one of those companies is going to survive. So anyway, I digress. As someone who's got more cash, I would love to know your idea about good stocks for the future. Well, that's literally what the channel does, so keep watching and you won't be disappointed. Hey, Fired Up Wealth, I've added an option. It may be interesting. Since stocks are expensive, many are on the sidelines with cash, although in my case, pretty invested. But elaborate your approach into buying expensive stocks, buy high, sell higher. So we kind of already covered that. And one last thing, I want to go into this. There was a good post today from a guy named Tony in our group about, it was just a chart, and it shows from Bloomberg as a source. It says Crescat Capital LLC, internet stocks PE ratio, and basically it shows 2020 that it's up to 160, and you know, back in 2011 it was 40. We kind of just already went through this, but I'll say it again. If you don't believe in internet stocks, don't buy them. I mean, it's as simple as that. You know, this group, most of us do like a lot of those stocks. At the same time, be diversified. No one's saying to go put 100% of your portfolio into WCLD. That should be like a percentage of your portfolio based on your risk and all those different things. I've only got something like, my whole portfolio maybe has 10% small cap cloud. And you say, well, you're doing all these videos on it. I'm doing all these videos on it because that's where the growth is. That's where the money's at. I've already made my money, guys. Like I have things like AT&T to collect dividends where I've already sold growth stocks like NetEase that went from 35 to 350 bucks. And I sold and bought things like Avi and Cisco and AT&T. I'm trying to help people that are younger than me, okay? I'm now in my early 40s. I'm trying to help people that are in their 20s and 30s that are trying to get to this point, and I'm trying to get them there. And they're not going to get there by investing into AT&T when they're 25 years old. It's just, unless they put a lot of capital into it, it's probably not going to happen. So you need some growth in your portfolio. You need to understand those risks. You need to diversify your portfolio, manage it effectively, all those things. So there is no one size fits all here. Everybody's going to have a different, suitability, risk, all those different things, goals. But this post was really good. There was a lot of good comments in it, a lot of good discussion in it. But the last thing I want to say is just because something is too expensive, it doesn't mean it can't go higher. And I'm not saying that means you should buy it. That's not what I'm saying. But I've been long Amazon since $500, and I've been told over and over countless times that the bubble's going to pop. And maybe someday it will. But here's the thing. If I make 600% and sell it before it does ever burst, it doesn't matter, right? I made the profit and I converted it into a dividend stock that's paying me, a blue chip dividend stock that's paying me to retire young. Even if it falls at 50%, if I'm up 600% and it falls 50%, I'm still beating the market in that time period. So that's how you got to look at that. Anyway, guys, I can digress and ramble on forever, but you get my point. I'm not saying that everybody should go out and buy every cloud stock there is just because they're all going to go to the moon. Never said that ever. Anybody that has followed the channel or the group or the Fired Up Wealth page or what have you, they know that I'm very diversified, that I basically wear several different hats. I've got an ETF hat, I've got a value play hat, a dividend growth investing hat, a growth hat. And these secular growth trends are going to be winners if you pick the right stocks, and they're part of an overall portfolio to help you outperform. That's what it's all about. So anyways, I hope you enjoyed this video. It's something different, something new. I'm going to do them periodically just to answer when I get a lot of questions, and I can't make, some of the ideas were good ideas, but I can't make one video on it because it's just not broad enough for a broad enough audience. So if you're new here, please subscribe. Hit the subscribe button on the bottom right-hand side. Click the little bell to get notifications. If you're not in the Fired Up Wealth group, again, on Facebook, you can go on there, search for Fired Up Wealth. There is a public page. You need to go there and you hit like, and then you go ahead and find the private group and you do an application. There's some questions you got to answer. Make sure you fill those out. We'd love to have you there. Thanks for watching. Have a great rest of your day. Take care.